Welcome to Breaking News to Trading Moves. Our objective today is to look closely at a recent government policy action affecting the clean energy world. We want to figure out what it means for specific companies, specific stock categories. Just based on the information we've reviewed, we're really tracking the economic reactions when expected government support gets pulled back suddenly.
Right. And the headline event we're focusing on is the U.S. Department of Energy, the DOE, terminating an assistance agreement. This was for a project to build a domestic lithium hydroxide refinery. And this wasn't a minor thing. It directly involved American Battery Technology. Their ticker is ABAT.
Okay, AB8. And the financial details here really tell the story of the immediate hit, don't they? We're talking about an agreement worth roughly $115 million in total for AB8. The DOE's part was planned to be about $57.7 million. But the really key number, it seems, is that when this termination notice landed, something like $52 million in reimbursable funds hadn't been paid out.
Yeah, reimbursable is definitely the word to zero in on here. It explains why this hurts ABAT right away. Basically, ABAT was spending its own money up front on the project, expecting the DOE to pay them back later for costs that qualified. So when those reimbursements are canceled, any money ABAT spends on this project now has to come straight from their own pocket, from their existing cash.
Ah, okay. So it directly impacts their cash flow.
Yeah.
And how long their current funding will last. It cranks up the pressure to find new money, I imagine.
Exactly. It shortens their financial runway quite a bit and makes finding new outside capital much more urgent.
Now, ABAT did say they're appealing this. They also mentioned planning to push forward anyway, pointing to money they'd already raised and also a letter of interest from the U.S. EXIM Bank for their Nevada plans. But you also mentioned this ABAT situation isn't happening in a vacuum. What's the bigger picture with the DOE?
That's right. This ABAT cancellation seems to be one piece of a much larger puzzle. The DOE is reportedly in the process of canceling 321 awards spread across 223 different projects. The goal seems to be saving around $7.5 billion. So this looks like a broader strategic change at the DOE.
From what to what?
It feels like a move away from maybe let's get money out the door fast to build domestic supply chains towards something more like let's tighten the reins, look closely at the projects, and focus on careful spending. And that immediately creates a kind of policy risk for any company that was heavily counting on future government grants to get big, expensive projects built.
Okay, so that policy risk premium you mentioned, let's trace that in the market. If ABAT's planned lithium hydroxide production is now uncertain, what does that do to the supply picture in the near term?
Well, it suggests that the expected growth in U.S. lithium hydroxide supply will be softer, at least in the near term. And that creates a couple of effects, really working in opposite directions. First, less new domestic supply coming online gives a bit more pricing support to the companies already established and producing, helps them out.
Makes sense. Less competition.
Right. But second, it also increases the potential for input cost swings for the EV makers and battery manufacturers, especially those who are counting on that pipeline of hopefully cheaper U.S.-sourced materials.
It does seem like these kinds of government actions creating uncertainty often open up gaps between winners and losers. So who are the established players, maybe breathing a little easier now that some potential competition just ran into this roadblock?
Yeah, we can identify three main groups that might benefit here. First category, established lithium producers and refiners. The thinking is pretty straightforward. If a new domestic project gets delayed or canceled, the existing players benefit. It supports their plant usage, their capacity utilization, and, maybe most importantly, their pricing power, near term anyway. You'd look at names like Albemarle, ticker ALLB, and Arcadium Lithium, that's ALTM.
And these are companies already up and running with existing operations. They aren't waiting on a government green light for their next big move in the same way.
That's a really important difference. Their competitive advantage, their moat, if you like, just got a bit wider, not necessarily because they did something new, but because a competitor hit a policy hurdle. It favors companies with scale and proven financing ability.
Okay, category one makes sense. What's the second group? You mentioned global lithium miners listed in the U.S.
This angle is more about import demand. If the build-out of U.S. refining capacity slows down, then the need to bring in processed lithium chemicals from elsewhere stays strong, to feed the U.S. battery plants that are still growing. So companies with diverse mining assets outside the U.S. are well-positioned. They can potentially benefit from any firmness in global prices driven by that continued U.S. demand. Think about Sociedad Química, Minera, SQM, they have big operations in Chile, and Lithium Americas, LAC. Their own production isn't directly hit by this specific U.S. policy change, but they benefit if U.S. demand for imports stays
I
robust.
got it. So less direct impact from the policy itself, more benefit from the continued need for imports if domestic supply lags. Now, the third category you flagged seems a bit less obvious. U.S. transportation and logistics. How does canceling a Nevada chemical plant actually help, say, freight railroads?
It comes down to the supply chain routes. If domestic supply takes longer to come online, then EV and battery makers might need to rely more on international supply chains for longer. That means more lithium materials, maybe raw feedstock, maybe already processed chemicals coming into U.S. ports. And that material needs to be transported inland, so it could support the volume of inbound materials moving through ports and then onto rail or intermodal transport.
Ah, so you're focusing on the specific flows, like
Yeah.
material coming in from overseas via ship, hitting a port, and then needing a long rail journey inland, potentially replacing material that might eventually have come from a domestic plant via truck or a shorter rail trip.
That's the idea. It could be a modest positive factor for major railroads handling those long-haul inbound routes. Companies like Union Pacific, UNP, and CSX, ticker CSX, it might not, dramatically change their quarterly results on its own, but it does remove one potential headwind, the idea that growing domestic production would eventually reduce the need for some of those long-distance inbound shipments of battery materials.
Okay, that clarifies the logic. Now let's flip it. Who's feeling the pressure? The losers in this scenario. Obviously, the subsidy-reliant battery materials developers themselves are first in line. We saw ABAT stock react already. Who else is in that boat?
Well, pretty much any developer whose plan heavily relied on getting that kind of government funding to lower the risk of their initial, very expensive build-out phase, now they face a potentially higher cost to get funding from private markets. Because when investors see the DOE pull back funds like this, they tend to demand a higher return to compensate for that increased execution risk. Standard Lithium, ticker SLAI, is another name in that space that operates in a similar environment, potentially sensitive to these kinds of funding and execution uncertainties.
All right, let's look at the next category. U.S. EV OEMs, sensitive to domestic input costs. Now, I get why a smaller developer is hit hard, but why would giants like Tesla or General Motors really feel the pinch from just one lithium project's funding issue? They operate globally.
It's less about the total volume of lithium available globally and more about meeting specific requirements, particularly those tied to the Inflation Reduction Act, the IRA. If the build-out of U.S. lithium hydroxide capacity slows down, it just makes it harder and maybe more expensive for these automakers to consistently source the required amount of domestic materials needed to qualify for certain valuable tax credits. If they end up having to buy from non-domestic refiners, even temporarily, or pay a premium for limited domestic supply, it makes their cost planning and margin calculations more complicated.
So it's not an issue of can they get lithium at all, it's more can they get the right kind of lithium domestically sourced at the expected cost to meet those IRA targets and lock in their planned profit margins.
That's it, exactly. They become sensitive to that cost volatility and the uncertainty around securing verified domestic supply. So companies where this domestic sourcing is a factor include Tesla, TSLA, and General Motors, GM. The challenge of getting that verifiable U.S. supply just got a bit tougher because the potential pool of suppliers is smaller or less certain near term.
Understood. And the final category under pressure, the engineering and construction firms, the E&C sector, that actually build these plants.
Yeah, this is about their future project pipeline. Companies like KBR, ticker KBR, and Fluor, FLR, they're specialists in the big, complex engineering, procurement, and construction, the EPC work needed for chemical refineries. If there are fewer DOE-backed projects moving forward, it could mean delays, smaller project scopes, or even cancellations in the future pipeline of work specifically for battery chemical facilities.
But wait. KBR and Fluor are huge. They build all sorts of things globally. Energy projects, defense, infrastructure. Does losing potential work on a few U.S. battery projects really move the needle for their overall business?
That's a fair question. It's more about the outlook for a specific growth area. While their overall business is diverse and large, many E&C firms have specifically highlighted their role in the clean energy transition. They've built up units focused on this, counting on growth driven partly by these government programs. So when that government funding looks less certain, the future visibility for that particular high growth segment gets a bit fuzzier. It might not tank the company, but it introduces some uncertainty into their growth story for that specific division.
Okay, that makes sense. It's about the trajectory in that specific area.
Yeah.
So mapping out these potential winners and losers gives us a way to watch how the market digests this news. The materials we looked at suggested tracking relative strength. How would you suggest listeners monitor that?
Yeah. A good way to see if this thinking holds is to just watch the relative stock performance over the next, say, week or two. Compare the established producers Albemarle, ALB, and Arcadium Lithium, ALTM, against the developers who might be more exposed to this policy risk, like ABAT and Standard Lithium, SLI. The idea holds up if you see the established names doing okay, maybe holding steady or even drifting up a bit, while the developer stocks clearly lag behind or struggle to bounce back from the initial news.
That performance gap itself might suggest a trading approach.
It could, yes. Some might consider a strategy that involves pairing trades, perhaps being long the established incumbent basket versus short the developer basket, especially when headlines related to this kind of policy risk pick up steam. You'd essentially be positioning for the relative financial stability of the established firms against the now higher execution risk faced by the ones more dependent on subsidies, using the policy change as the catalyst.
Of course, policy situations can change fast. What are the key things to watch that could potentially reverse this whole dynamic?
Absolutely. The first thing is that appeal process by American Battery Technology. If they manage to win that appeal, that changes things immediately. Or, just as important, if they announce alternative financing that completely plugs that $52 million gap, particularly if that EXIM Bank letter of interest turns into a concrete loan agreement. That kind of news could definitely reverse the pressure on the developers. So keep an eye out for specific financing updates from ABAT.
Okay, good point. So maybe a final thought for you, the listener, to mull over. Considering the DOE's apparent focus on saving money, cutting $7.5 billion across over 300 awards, does this single event maybe tell us something broader? Could it suggest that this long incumbent versus short developer idea isn't just a short-term reaction, but perhaps a more structural way to think about navigating risks in the whole clean energy build-out, where government support plays such a big role?
And just a reminder for everyone listening, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.